Hi everyone, welcome to our first screencast, Mastering Adjusting Entries. This screencast hopefully will serve as a review for what you learned in financial accounting when you covered the topic of adjusting entries and the adjusting process. So let's begin. We know that in the business world we can have two accounting methods really that we've discussed or that you need to know here available to a business to use. One is the cash and one is the accrual basis. What's the differences? Well, you may recall that under a cash basis of accounting, we are only concerned with when the cash physically comes into our business and when the cash physically leaves our business. So in other words, we are going to record revenue when money comes in. Maybe we provided a service or provided a good, but maybe we still have to do that. That is irrelevant. The only thing we care about is that money came in, and at that point, we are going to call that revenue and record it. Likewise with expenses. We're not concerned when the expense is incurred. We are only concerned when we pay that expense. So as soon as the money leaves our hands, we will then recognize the expense. This is very different, cash basis is very different from the accrual basis of accounting. So under the accrual basis of accounting, we're not concerned with when the money or the cash comes in or when the money or the cash goes out. We are concerned at what point did we earn the revenue? At what point did we deliver the goods and services and we can expect payment in return from a customer? It is at that point that we are going to recognize our revenue. Likewise with expenses, we're going to recognize them when they are incurred, not necessarily when we paid for them, but when they happened or when the time has passed and the expense has been incurred. Now, the timing might be that these two would have the same results. Maybe you paid your bills when you incurred your expenses, and maybe your customers paid you as soon as you provided the good or services. But in the real world, there's usually a timing difference. So let's follow up with an example. In 2008, Pubco offers 2-year subscriptions to New Magazine for $20. That's 8 quarterly issues at $2.50 and collects $20,000. So they're $20 each and the total is $20,000. So that tells me there's 1,000 2-year subscriptions. The cost is $6 a year per subscriber. So their revenue is $20,000, but it's going to cost them the $6 times the 1,000 subscriptions is $6,000 per year. So each year it's going to be a $6,000 expense. That expense is paid at the time of publication. Okay. Lastly, Pubco takes out a 2-year loan for $10,000 at 10% simple interest rate. Both interest and principal are payable at the end of 2 years. So let's go to the next slide. They're going to show us what we would recognize for revenue and expenses under the cash basis and what we would recognize under the accrual basis. And we're going to consider both years, 2008 and 2009, because here we are dealing with a 2-year subscription. Here we go. So under our cash basis of accounting, 2008 was when we collected the entire $20,000, even though the subscriptions were to cover a 2-year period. So under our cash basis of accounting, we are going to recognize that entire $20,000 when we received it. The cash came in at that point. Conversely, under accrual basis, we are going to say this is a 2-year subscription. So we had to provide subscriptions for all of 2008, then again for 2009. It is at the end of those 2 years, each of those years, that we earned $10,000 and then another $10,000 for 2009. Okay, so now let's think about the expenses. It was $6 per subscription at the point when they published each of the subscriptions. So since this is a magazine, or these have to be published timely, they're done in the correct year. So in 2008, they needed to spend $6 times 1,000 subscriptions for $6,000, and they paid for them in 2008. Likewise in 2009. Coincidentally, or not coincidentally, but because the expense and the timing of the payment happen at the same time, our two methods of accounting are going to result in identical expenditure amounts over the 2 years. Okay, so like I said, I mentioned in the earlier slide, that's definitely very possible. But now let's go down to interest expense. This is interesting. So if we flip back very quickly and we see it was a 2-year loan they took, $10,000 at 10% simple interest rate. Simple interest, and you need to know this, is principal times rate times time, and it is for 1 year. So 1 year's worth of interest was $10,000, our principal, times 10%, our rate. Our time is 1 year. So 10% of $10,000 is $1,000. That's for year 1. They're going to repeat that and pay the same amount for year 2. Both interest and principal are payable at the end of 2 years. So under our cash basis of accounting, we're not paying any interest until the end of that second year. So in 2008, even though $1,000 of interest had been incurred at that time, no cash left our hands. So we do not record $2,000 in interest expense until 2009, because that is when we in fact paid the $2,000 back, or paid $2,000 in interest. Under accrual accounting, we are going to capture the interest expense when it was incurred. There was $1,000 incurred each year over the 2-year period of this loan. So even though we did not pay the $1,000 in 2008, we are going to recognize the $1,000 in 2008 and the other $1,000 in 2009. Okay, it's important to note when you're comparing cash and accrual, eventually your results will be the same. So if you look here, you had a $14,000 profit in 2008 under the cash basis, and in 2009 under the cash basis you had an $8,000 loss. This nets to a $6,000 profit. If we come over here to our accrual basis, we see each year we had $3,000 in profit for a $6,000 total profit. So in total it's the same, but what's very important to note that the timing of the profits may be different. Okay, and clearly if we had people interested in seeing what sort of profits we were making in 2008 and they had nothing else to compare, they didn't see the end results over time, it would tell a really different tale, wouldn't it? $14,000 profit in 2008 and then only $3,000 profit in 2008 under the accrual basis. So it's something to be aware of. If you are obligated under GAAP to have an accrual basis accounting method, then this is what you would be doing as a bookkeeper. A lot of the smaller companies are not obligated, and it's perfectly fine for them to use the cash basis of accounting. So this is a slide we saw earlier, and they just added a little something down in the bottom here in yellow. Under the cash basis, if it helps, you can think of it like this. Our earnings equal the cash received, the physical cash received, minus the expenses paid. That is actually paid. You wrote a check, you dropped off cash, whatever it is, but the cash left your pockets. That's how you how you calculate earnings under the cash basis of accounting. Under cash basis, we are not concerned with when you earn the revenue or when the expense has been incurred. Okay, that is the exact opposite when we come to consider the accrual basis of accounting. Under accrual basis accounting, our earnings are when we earn the revenue less when the amount of expenses that have been incurred. Okay, when cash is received or expenses are paid is irrelevant. as I mentioned already, cash basis is not GAAP, generally accepted accounting principles. So if you are obligated, if you're a publicly held company, then you are forced to use the accrual basis of accounting. However, even if you're not publicly held, many companies adhere to the accrual basis of accounting. So you really, as bookkeepers, will need to know both methods. Let's go on. As we continue on, there'll be a lot of examples and problems that will help you sort of solidify the concepts. So let's look at one more. You're a caterer and the transactions you're about to see occur in March. What should you report as March revenues and expenses under, guess what? Yes, we're going to do the cash basis and the accrual basis. So here are our scenarios. You prepay $2,400 rent for 4 months. So you're prepaying it means you're paying in advance. So if we have a building we're renting for January, February, March, and April, that's 4 months, we're going to pay the entire 4 months rent on January 1st. We haven't used the space yet. That's what they mean when they say prepay. So if you prepay it, under cash accounting, what would that be? Prepaying it, we would call it an expense because the cash has left our pocket. However, under the accrual method of accounting, we are not going to recognize any expense until we have spent time in the facilities or the office that we are in fact renting. So I believe in this example, it said we were talking about March. So let's say we paid $2,400 in advance for March, April, May, and June. Well, at the end of March, when we're going to put together our accounting reports, we have to account for 1 month of expense that has been incurred because we spent 1 month's time in the space we are renting. So under the accrual accounting method, we are going to include $600 of expenses. How do I get that? $2,400 rent for 4 months. That's $600 per month. 1 month's time has passed. Okay, the screencast time has almost run out, so I am going to pick this up on the next screencast. That would be Mastering Adjusting Entries 1.2.